Click the bell icon to get latest videos from Ekeeda.
Hello friends, today we are going to learn what is accounting procedure for amalgamation of firms. What is amalgamation of firms? We have learned earlier, amalgamation means joining of two or more firms. Accounting of amalgamation involve closing the books of vendor firm and opening entries in the books of purchasing firm. So there are two major stages of accounting in case of amalgamation: closing the books of vendor firm and writing the opening entries in the books of purchasing firm. Okay, so let's go with first part. Closing the books of vendor firms will include what? I told you that your firm is getting closed. Now imagine if you are an old firm, you are closing your books of account. That too you are not getting any money for that. You are going to become a partner in the new firm. Don't you think you will like to take the advantage of situation where you will close your books and you will value your assets and liabilities at its actual worth? So here actually there will be a revaluation of your assets and liabilities as on the date of amalgamation. So you will prepare in the books of vendor firm revaluation account. Revaluation account is exactly the same revaluation account you might have prepared in case of admission, retirement or death of partner. When there is a gain to the firm, revaluation account will be credited, and when there is a loss to the firm, revaluation account will be debited. When assets increase or when liability decrease, there will be a profit. So what would be your entry for revaluation of assets upward and liabilities downward? Simple entry will be passed: asset account debit or liability account debit to revaluation account credit. Reverse entry will be passed when there is a decline in the value of asset or increase in the amount of liability. When there is a decrease in the value of asset and when there is an increase in the value of liability, in both the cases we are at loss. So your entry will be revaluation account debit to asset account and to liability account. So your overall assets and liabilities will get revalued, and once they get revalued, after getting it revalued, it will get transferred to the new firm. Now before that, we will close the revaluation account. Revaluation profit or loss will be shared by the partners in their respective profit sharing ratio. Your assets at revalued figure will be transferred to the new firm. So just imagine your entry: new firm account debit to assets account at a revalued figure, because already we did the revaluation. When you transfer the liabilities, your entry will be liabilities account debit to new firm account will be credit. So in our book, asset account is closed, liabilities account is closed, and both of them will be transferred to new firm account. In new firm account, assets are debited and liabilities are credited. I hope you are understanding. This is what we have done. Thereafter, when you close partners capital account, whatever balance is there, that will be directly taken and that will be also transferred to new firm. So imagine partners capital account having a credit balance. So my transfer entry will be partners capital account debit to new firm account. So finally, if you check your new firm account, it will get tally. Very simple procedure is there. What I need to do, I will prepare a revaluation account. It will be exactly the same revaluation account as I was preparing for admission, retirement or death. When revaluation leads to a profit, revaluation account will be credited. For example, asset increase, liability decrease. My entry will be asset account debit, liability account debit to revaluation. Reverse entry will be passed when there is a decline in the asset or increase in the liability. Your entry will be revaluation account debit to asset account and to liability account. Revaluation profit or loss will be transferred to partners. Assets at revalued figure will be transferred to new firm. My entry will be new firm account debit to asset account. Liabilities will be transferred to new firm. My entry will be liabilities account debit to new firm account will be credit. In this way, new firm account will have some difference, and that some difference will be disclosed by your partner's capital account. So your partner's capital account is also closed and it is also transferred to new firm. Your entry will be partner's capital account debit to new firm account. So your new firm account will get closed on its own when you transfer your partner's capital. It is how you will close the books of vendor firm. Second accounting procedure in your amalgamation of firm: recording the transactions in the books of purchasing firm. Now just imagine you are a purchasing firm. What we are acquiring from the old firm? We are acquiring assets, we are acquiring liabilities, and we are acquiring partners capital. So what will be our entry? But logical: assets account debit at agreed values to liabilities account credit at the agreed values, and to partners capital account will be credited at their transferred values. So simple entry will be recorded for acquiring the business from the vendor firm. Now just imagine the goodwill is there when you take over the firm. There is a valuation of goodwill. So old firm might have that goodwill, you might have paid for. That goodwill your partners may decide to write off. So new firm will decide to write off the goodwill from their books of account. So their entry will be goodwill account will be credited and all partners capital account will be debited. So my entry will be for writing of the goodwill if instructed by the question. All partners capital account debit to goodwill account. Thereafter, you may come across few situations where there is a common amount between two firms. For one firm it might be asset, for another firm it might be a liability. I can say these are the mutual owings. Maybe a possible for firm A, firm B is a liability. That is creditor. For firm B, A is a debtor. So there is a possibility when you take over the business, assets and liabilities will include such debtors and such creditors. Same will happen in case of bill of exchanges. There may be some bill of exchange accepted by firm A. So for firm A it is bills payable, but for firm B it is bills receivable. There may be some other things like a loan taken, loan given. I can say these are the mutual owings. Once you amalgamate, you become one firm. Payable is to you, receivable also from you. These amounts will get mutually cancelled by passing simple entry liabilities account debit to assets account. So this will eliminate same item appearing on the asset side and same item appearing on the liability side. In this way, amalgamation accounting will comes to an end. It is very easy part. Now we have to learn it along with the question. Only learning the theory will not help you. We have to go for a practical questions on that. For that you need to watch our channel again and again. We are coming up with the problems of amalgamation of firms for your CA Inter course, which is must see videos. Thank you for watching this video. Keep liking and keep sharing our video. Thank you so much.